Here on set to talk about what this means for investors is Matt Swain, CEO of the direct PE firm Triago. It's being acquired by the California investment bank Houlihan Lokey in a deal that officially will close next month. Matt, welcome. Good to have you with us.
Thank you for having me.
Let me make sure I'm understanding what a direct deal does. In a traditional private equity format, the private equity company, whether it's Blackstone or Carlyle or any of the names we know, assembles a fund of money drawn from institutions, private sources, family offices. And then they go out and they find companies to put that money to work in. Under your model, it is inverted. You find the company first that you want to target, and you then go and solicit capital from private investors, institutions, and so forth. Am I right on that?
That's exactly right. Again, a direct is raising capital around a single company outside of a fund structure. Most structures today for private equity funds are what is known as blind pool. Blind pool means that you raise money around a sector, an industry. You know the thesis behind what you're investing behind, but you don't know the actual companies that you're going to be getting exposure to. Directs turns this on its head. You are buying into a very specific company that you know will fit within your portfolio.
And the money then gets to work, I assume, quicker, because often in those private equity funds, the money can sit for a while, collecting a fee for the Blackstones of the world, but not really being productively put to work. Am I right on that?
Absolutely. Do you know how much blind pool capital is currently sitting on the sidelines?
No idea.
$3.7 trillion, more than the GDP of France. I mean, in this type of environment, you can't have that much money sitting on the sidelines, paying a fee to private equity firms. You have to be able to invest it quickly, and your money has to grow, especially with 4 or 5% type interest rates.
So walk us through some of the advantages, though, not just for investors, but also for the target companies of going this route.
Yeah, these deals are categorized more by operational value add. You know, not all private equity funds are getting it wrong. The ones that are trying to generate returns through financial leverage, they are getting it wrong. But what I would tell you is true of these private equity deals or direct deals is that almost all of them are focused on adding value to the company on a day-to-day basis. You have these managers actually moving on-site, taking interim roles at the company, trying to find customers for these assets. And that's really what characterizes these types of deals.
So when you target a company that you're going to put capital into, are you targeting companies that are, quote, distressed situations, or are these successful companies that are growing and you think can grow even faster with your infusion of capital? That's question one. Question two is, are those target companies welcoming to the outside capital that you're bringing?
It's a good question. I would tell you these tend to be lower middle market buyout companies that are profitable. They have to have some type of runway of growth. If they don't have a runway of growth, quite frankly, investors aren't interested. Managers tend not to be interested. This is not the best structure for them. So as it relates to number one, it's a profitable company that has a long runway where you can invest behind, usually with some type of macro tailwind.
And then in terms of what this means for the incumbent firms, the Blackstones, the Apollos, are they doing this as well, or do they see you as a threat in the fact that you're doing this?
Look, I won't comment specifically on any large cap buyout firm, but what I will tell you is they're cognizant of the space. A lot of these firms are actually looking into the space. You may have seen recently, Tyler, you just mentioned it, we just sold to Houlihan Lokey. Some of the competitors during the actual sale process of Triago were buyout firms, were these large private equity firms that want to know how to best access these type of deals. Because although the results are early,
they want to continue those kind of deals. They don't want to squash you.
They do not want to squash
because you're the goose that's killing the golden egg.
We're still a small part of the private equity fund market. We're about $31 billion of deals, whereas the private equity fund market is $800 billion of deals. But what I would tell you is there's just a lot of alpha in these deals. And if they can unlock that alpha, they want to play in that space.